Hi, this is Randy Finney with the Right Side of the Chart, and today is Tuesday, March 12th, 2013. And in this video, I'd like to talk a little bit about the Dow and some of the top holdings in the Dow. For those of you who follow the site regularly, you know I don't often talk about the Dow Jones Industrial. I don't chart it often. It's ironic because the Dow to this day is still the most widely quoted and discussed of all the probably all the indices in the world, definitely in the U.S. here, and yet it is the least significant, in my opinion, as far as from a technical perspective or what's going on in the U.S. economy. Reason being, as the name implies, the Dow Jones 30. The Dow Industrials only has 30 components. It would be one thing if that was an equal weighted index, but it's not. Let's dig in and take a look here at the weightings of the Dow. This is a updated as of Tuesday, March 12th. That's today. So this is updated weighting breakdown of the components of the Dow, I should say. And here are your components here on the left, all 30 stocks. These are the their percentage weightings in the index. As you can see, IBM has the largest weighting at over 11%. So the top holding alone makes up more than 10% of that index. And the next column here just shows you a cumulative total here. So if we look over here, when we get down to the 9th position, which currently is Travelers, the 9th largest weighting, those top 9 holdings, or components I should say, in the Dow Jones Industrials makes up over 50%. Over half the returns of the index are due to these top 9 holdings here. So a very unbalanced index, a lot like the NDX 100. I've done quite a bit of videos on that in the past in coverage, and on that index I tend to focus only on the top 10 holdings, which going from memory make up well over half. I think it's maybe close to 70%. I've covered that in the past. So that's another very unbalanced top-heavy index, and so you're going to have the bulk of the returns attributed by the top holdings. Now keep in mind, and one reason that I don't put too much stock into the excuse me, I'm talking too fast here, folks, that I don't put too much stock into the Dow making all-time highs here, is that over time, let's go back to this chart here. Over time, this is this chart goes back to the early 70s. The Dow today isn't even remotely similar to the Dow back then. In fact, the Dow today isn't what it was a year, 2, 3 years ago. The Dow is constantly changing and tweaking their components, rebalancing, replacing components. And although I haven't read this or can prove this theory anywhere, I'd be pretty certain that Dow Jones, the company itself, manages the components for optimal performance in the index. In other words, I'm sure they have technicians and fundamentalists that take a look at which components are likely to do well going forward and which ones aren't, and that probably plays into which stocks are jettisoned and which ones are added to the index. So either way, it's again something to watch. And now let me say this: the reason I'm about to spend some time covering these top 10 components is because the importance. These are 30 of the largest companies in the U.S. These are multinational mega-cap companies. In the majority of these companies are in the S&P 500, or in fact, they're top holdings in the S&P 500. So I do find importance in these stocks, and that's why I'll spend much more time covering the individual stocks than I will the Dow itself. While we're here, on this chart, we're looking at a monthly chart. I'll just talk real quick on what I see. I'm not going to pay attention to, as I said, any long-term trend lines are irrelevant. But in recent years, what we're looking at here is a sort of a rising triangle wedge-type pattern. But most importantly are the divergences in place. If you follow the vertical line down, from this point, on just about every indicator oscillator below, we're looking at the ROC, rate of change 12, the RSI 14, the PPO. We have negative divergence in place. In other words, these indicators or oscillators are making lower highs against higher highs and prices. And since we had this new breakout in all-time highs, so we obviously have a higher high in prices. And that actually goes all the way back to this peak here. So again, I talk on this a lot. These divergences, trend lines, are every bit as effective on these longer-term time frames from my experience and years of trading and investing as they are on the shorter-term time frames, whether you're looking at a 15-minute chart, 60-minute daily chart, weekly. The thing is, they just take a lot longer to play out because each candlestick here represents 1 month of trading. So for us to have a confirmed break of the Dow Jones the Dow Industrials, let's say we dropped 1,000 points tomorrow, until the end of the month, we're only halfway through the month, we'd have to have a closing monthly candlestick close, pretty far, well below that trend line just to signal a trend line break. And we could drop 1,000 points tomorrow and then snap back up in there by the end of the month, and that's not a confirmed sell signal. So again, just something to look at. Monthly chart on the Dow, and I do believe over time at some point this year, this uptrend line will break, and we will most likely have a correction that rivals anything that we saw over the last few years, if not a more lasting top, i.e., beginning of a new bear market. Okay, I jumped forward here to IBM. I'll go through these components. I'm not going to cover all 30 components. That would take forever. I'll try to keep this video as short as possible. In fact, I won't go in depth on all 9, but I will cover those top 9, or at least touch on the top 9 that I talked about that make up over half the Dow. So if you want to know where the Dow is going, all you have to know is where the top 9 components are, since that makes up over half the performance, and you'll likely have a good handle on how to trade the Dow if that's your thing, or at least where the Dow might be going if you're concerned on that. So we're starting out looking at, this is a 2-day period. If I don't mention them, you can take a look up in the upper left-hand corner of these charts, and that will show you the time frame that I'm viewing. This is a 2-day period chart, meaning every candlestick represents 2 days of trading action. And I do have this little circle drawn. That's just because I don't have a smooth, or I should say, I was trying to draw a rounded bottom here. So from looking at the recent price action over the last few months, or actually I should say almost all of 2012, at least going back to early April, IBM has put in what could be viewed as a rounding bottom pattern. That is inherently a bullish pattern. So what you'd want to watch for if IBM were to break out above the top range of the pattern, which is this horizontal line here, right around current prices, that is a bullish breakout. So, let's call a spade. I'm looking at on the glass half full, a potential rounded bottom pattern. Yeah, let's see if we do get a breakout. Will it be accompanied on volume? I have a lot of concerns about any breakouts at this point failing. Now that was the glass half full approach. The glass half empty approach, let's look at these 3 peaks that we have here, 1, 2, 3. They're basically 3 equal peaks. As you can see, they're labeled 1, 2, 3. And now let's take a look down below on the this time frame. I'm looking at a MACD and the RSI, and what we're looking at are a series of lower highs or lower peaks. 1, 2, 3. High, lower, lower. High, lower, lower. So that is what we refer to as negative divergence, and this could prove to be what we call a triple top pattern, which is a pretty powerful, long-lasting reversal, topping pattern. So really, the key to IBM is where it goes from here. Don't jump the gun. 1 day's price action, one big move, 1 day down, 1 day up. You're really going to need a couple weeks here to see which way this goes. Any reversal, will it stick, or will prices shoot back up? Any break above, will we see some volume come in and prices continue to move higher? So we might not know how this plays out for a few weeks at least, but something to watch. We're looking at here, this is a trend line that goes back to 2010, around August. And as you can see here, this was a nice rising wedge pattern. Ignore the blue line, if you will. We'll talk on this in a week on the weekly chart here in a second. The white trend lines, as I'm highlighting here, up here, this is a sort of a rising wedge pattern. We had negative divergence back then. We had a higher high put in from this point to this point, with the RSI and the MACD both diverging, meaning moving down, making lower highs, and then prices broke down. It's something that I'll talk on a little bit later. I'm of the mindset there's a good chance that that we had a bear market that's actually started back in October 2012. I can make that case on a lot of stocks right now. I am quite aware that many indices have gone on to make slightly new highs here, but I can look back at the peak in 2007 when most indices topped in October 2007. We had quite a few sectors that went on well on, such as energy and several others that went on to make new highs well into 2008, both sectors and indices. So it's all relative, and where we go from here is key, because if we do push up a whole lot higher, we're going to have just about every index. I'm looking at the NASDAQ and the QQQs especially, and all these other indices. If we make another high, well, that doesn't eliminate, it would eliminate the chance that a bear market started back in October 2012. And that's semantics anyways, folks. I mean, whether we did or not, there's quite a few stocks that have been in bear markets since last year, and then quite a few that continue on to make new bull market highs. So I probably spent more time on that than I should. Let's go ahead and jump into the weekly chart here. Again, to me, this is a pretty clean chart. Here's the bull market uptrend line. In other words, IBM bottomed. Using my example, the markets itself, the stock market itself, or most major indices, bottomed in early March of 2009. IBM, like some other stocks, Apple included, bottomed back in 2008. So this was the low. There's a reaction low. This is how I draw trend lines. I won't spend too much time talking on that now, but often I'll exclude a wick or an overshoot, a tail on a candlestick or wick, if it's if I have a lot of other bodies and or tails or wicks that line up. So I think this is a very solid, well-defined uptrend line marking this entire bull market run in IBM. Prices broke down here back in, didn't mean to do that. That was back in June, late June, or sometime in June of 2012, and we pushed up like is very common. Prices pushed back up to make a back test right here, and that was in October. And that's where I maintain, if IBM cannot go on to take out that previous high, then, from a technical perspective, the uptrend was broken here. Prices have yet to make any higher high than they retested this pattern. So I would put this as a possible, the top for IBM. Let's see where we go from here. Again, only time will tell. But if you look at here, again, triple top, 1, 2, 3 equal highs, and now you look at the divergence. In the beginning, it was we had some slight divergence. These divergences are building. We're making considerably lower peaks in the MACD and RSI, and as long as that's in place, that to me is bearish. Even if IBM were to go on and make a new high, it would most likely be a false breakout or a bull trap because of these divergences. Is it possible that prices just continue up and these divergences are burned through? Absolutely. If the MACD gets above this level, this horizontal line that I'm holding here, and the RSI comes and takes out a new high, let's say it gets well above the 70 level again, sure, those divergences will be burned through, and IBM might have some legs to run. Okay, I've spent a lot of time on IBM, and again, that is the largest holding, so I'll be a little bit quicker on the rest. This is a monthly view now, and the big picture on IBM is this. These blue lines indicate this very large wedge type pattern, and when I look at this chart, this is what I see. First and foremost, I see the divergence here. We had these series of highs back here. Prices recently making a much higher high against divergences on just about every indicator and oscillator below. On my monthly charts here, I have the ROC, or rate of change 12. I'll keep these on all the charts tonight. The RSI 14 and the PPO, which preferring this on longer term charts at times over a MACD, but it works very similar to the MACD. And so as you can see, significant divergences, and if this chart were on any time frame, down to a 15-minute, 5-minute chart, I would be bearish. I would be looking to establish a short position here at the top of the wedge, even on a potential overthrow, and expecting prices at the very least to come down back to the bottom of this wedge. They've been extended and at the top of that wedge for a while. And then more importantly, let's zero in on these sub-trend lines. Take a look. I'll talk on this a little bit. I've spent a lot of time on a video I did earlier in the year that I recommend you take a look at on Caterpillar. I went into detail talking about these, what I call sub-uptrend lines or downtrend lines within a larger pattern. So what we have here are these sub-uptrend lines, and keep in mind these are multi-year uptrend lines. This one starts all the way back in '94 and defined the entire bull market run from CAT up until the internet bubble burst back in 2000, and you can see that signified the beginning of a new bear market in IBM once this uptrend line was broken. And like so often happens, we had a breakdown, prices fell, and pushed back up to retest, even went on to make a little, almost challenge, try to make a new high, but failed. So this was the breakdown, retest. At this point, we started a new bear market in IBM, and along with the overall stock market. That bear market was then defined by this downtrend line. It's really this simple. I have a tremendous amount of faith in downtrend lines. Nothing in trading is perfect, but these downtrend lines are so simple and effective, and given you have to give them some room on these monthly and longer term time frames, or you confirm them on the shorter term time frames, or at least zero in on your entry points. But if you look here, that downtrend line was finally broken back in, let's see, that was 2007. And that put IBM in an uptrend, smaller uptrend, still a multi-year uptrend, lasted several years, and that was defined by this uptrend line. So that is a sub-trend. This was a uptrend within a larger bear market. Maybe that's an inaccurate description. Either way, what I'm getting at is this uptrend line, prices then did break. Look at that impulsive selling on the break of that very clean uptrend line. And where did they come back? They came back to back test the original, or the previous, I should say, the previous bear market downtrend line. So, and that would have been a nice long entry there. As I often do on the site, I like to buy short back test of uptrend lines, or go long on back test of broken downtrend lines. And that set off the next and most recent uptrend, multi-year uptrend in IBM, which again was broken back and retested, I should say, back tested in late October, sometime in October. And so far, I'm viewing this as a break of a large, and look at the scope of this uptrend, much larger than that one. And I would, all other things being equal, if I had a gun to my head and I had to either go long or short IBM, and then get on a boat and sail around the world for 6 months or a year, I would be short IBM here, expecting it to come down somewhere here like this, and within the next year or so, and at the very least come down to this wedge. Now if it did that, that's a very large wedge pattern with negative divergences in place. So if you want my honest opinion, I think there's some horizontal resistance there as well. I would expect a bounce there, a little jig up, and then ultimately see this break to the downside. That doesn't mean the world's going to come to an end. It just means IBM may not be the stock that it used to be. So, okay, a lot of time spent on IBM. Let's move forward and cover the rest a little bit quicker here. Here's Chevron Texaco CVX. This is the second largest holding at about 6.25% weighting in the Dow. We're looking at a daily chart here. Nothing exciting right now. We have a potential double top. These are the previous reaction highs. Bullish if CVX can power through there. Taking a glass half full approach. This looks sort of almost like a bull flag pattern here. So maybe that does give the stock the impetus it needs, or the energy to bust on through there. But so far, as you can see here, look at the candlesticks. Zoom in a bit. We've struggled quite a bit here at these previous reaction highs. So that's just a level to keep an eye on CVX. Not much to say down below. If you look at the MACD and the RSI, they are flat. So really flat line divergence. Prices are making an equal high against equal highs in the MACD and RSI. So really not too much to read through there. Just keep an eye on where prices go. There's a 2-day period. It really looks the same. Now, weekly charts. Now we're starting to look a little bit more bearish here. Again, uptrend lines say it all to me. Here's the primary uptrend line leading into, the energy stocks, as I mentioned, were one that their bull market went in well into the middle of 2008. So well past the peak of the last quote-unquote, official bull market, which ended in October of 2007. And again, I put a lot of emphasis, or a lot of stock into these divergences. How did CVX end? Well, we had this primary long-term well-defined uptrend line which went back for years. I think I can even go back a little farther here. Yep, we pick it up in 2003, and at the peak we had some very clear negative divergence in place on the RSI and the MACD. So like so many of the rising wedge patterns that I draw, breakdown, and then boom. And in my opinion, the longer divergences form, the harder the more impulsive, or the deeper the move down will be. So we're looking at here, given there was a little bit more of an extended run, this trend line went from 2003 all the way to 2008 before it broke down. The current bull market trend line runs from about beginning of 2009, and we're still way up there, ways from the bottom of it. But this is a very important trend line to keep an eye on. And just like back then, we have negative divergences. In fact, we have much larger divergences. And this, folks, is why longer term I am looking for a very sizable correction, and I'll just say it, a bear market sometime here in 2013. And I would be shocked if we ended the year higher than where we are today. But I won't be caught short that whole time. As you know, I trade patterns, not the market, and I will continue to trade and post the best looking long and short setups. But in doing this tonight, the reason that I'm spending so much time on this, in my opinion, helps to formulate a long-term bias in the market, because if and when this correction finally comes, for those that believe that the market is going to Dow 20,000 or whatever some of these numbers that are being thrown out there are right now, those traders or investors are going to be looking to buy the dips. And if I see all these long-term bull market trend lines go, like I said, a lot of them have already went, we've already retested, that makes the difference of whether I want to go aggressively long at support, or I expect that support to break and prices to move down quickly, because bear markets are very painful for longs, just like bull markets are painful for shorts. In a bull market, shorts continue to try to short resistance, and prices just burn right through. Bearish patterns, like head and shoulders, look like they're going to play out. They break down, and then all of a sudden they reverse to the upside, and they don't even let the bears out. So that is why I spend a lot of time on these long-term charts, trying to formulate an overall bias to help me position, over the next year or so, and I have admittedly slanted my holdings and my positions, regrettably, to the short side since last October, or September, I should say, where I thought, was a good chance that we had seen a top in the market. And again, as far as the indexes go, yes, we have some breaking out, quite a few breaking out to new highs. So at this point, I can't say that we're in a bear market, but I can say with certainty that a lot of stocks are, and I think that case can be made that we may have started one back then, or at least a recession very soon here, if not recently. So CVX, big bearish rising wedge pattern. This is a much longer term trend line. Let's take a look at the monthly chart. This trend line goes all the way back to 1985, and if I were a betting man, which I am, I should say, by definition as a trader, if I were a betting man, then I would bet once this rising wedge pattern, very clean, clear pattern, clear negative divergences in place, when this breaks, and if you look at where we are, patterns usually break around 70% to their apex, the apex of the pattern on a wedge like this or triangle pattern, and we're already there. They can go 80, sometimes 90%, but this thing, if it's going to go one way or another, it's probably going to go down soon, and when it does, I would say this is a very, very likely target to see sometime in late 2013, early 2014. Probably 2014 is when that would be hit. So that's my opinion on CVX. Okay, sorry folks, I just looked down. I could talk on the markets all day long, as you know. I just love this stuff. So I know most people don't like a 25-minute video, and I've just actually crossed the 26-minute mark. So I am going to accelerate this and only look at some monthly or weekly charts. We'll run through these. 3M, as you can see, very clear, and this is a bull market uptrend line, monthly chart, 2009. Here's the uptrend line. There's the divergences in place below, negative divergences both on this peak here to this higher peak, as shown here on the ROC and the PPO, as well as longer term divergence if you want to take it back all the way to this uptrend line here on top. That goes back for years. So again, looking at this chart, you could blindfold me or hide what time frame and show me this chart on a 5, 15 minute, 60-minute chart, daily chart, and I would be looking to short this stock. So anyways, that's my opinion. As far as 3M goes, I believe we're in a secular bear market. Right now we're in a cyclical bull within a much larger secular bear market that started back in 2000, and looks like 3M started their broke this long-term uptrend line, this 20-something year uptrend line back in 2008. Prices have now pushed back up, made a near retest, and again, we're seeing prices move up here because the Fed is inflating this market. They're devaluing the U.S. dollar by printing money. The dollar has dropped in recent years. They're flooding liquidity into the system, so that's going to skew the visual aspects of a chart, without all that dollar debasement, money printing. Undoubtedly 3M would not be up at this level, and most certainly wouldn't have made a higher high here, nor would have had the market overall. So you want to do an inflation adjusted chart of the Dow or anything else, and I think it's very clear that we're in a secular bear market. I know the bulls will argue otherwise because the markets are going on to make higher highs, especially the Dow here with the all-time high. So anyways, all right, moving on. McDonald's, MCD. There's my monthly chart. Nice clear trend line from all the way back to 2003. Trend line was broken here. Again, we're looking at a multi-year trend line breakdown. Here's what happens. Here's what happened the last time we had a long-term trend line breakdown back in 2000. There was a following bear market. So McDonald's has held up well in the last few years, especially all things considered, during the last bear market, but not looking so hot from a longer term perspective here. UTX, United Technologies, trend line break, retest, two back tests of that trend line, and there we are today. Again, well, I haven't drawn it here. If we didn't have all these divergences in place, if you look at these three peaks, higher price peaks, 1, 2, 3, against these lower peaks down on the RSI and the MACD and just about any other thing you look at. Caterpillar, Again, if you haven't done so and you are interested in this kind of stuff, take a look at the video I did earlier in the year. Just scroll down on my videos on YouTube, right side of the chart channel, and I did an in-depth discussion on Caterpillar, and I put it on. The Caterpillar was a short at the time, and I can't remember right now exactly where it was shorted, but somewhere in here. And that trade played out, was a very profitable trade, played out exactly as expected. And this comes back to the fact these are monthly charts, monthly trend lines, and I just cannot continue to reiterate how much faith I have in these trend lines. Again, I talked about this large channel here. Within this large uptrend channel, we have these sub-uptrend lines. The yellow ones were what I call primary uptrend lines. The white ones were more minor uptrend lines, and you can just trade CAT all day long if you're a longer term swing trader. I know there's a lot of frustration from traders who shorted in the last few months and are getting stopped out or seeing losses. Sometimes when you're swing trading and you're using these longer term charts as your guide, you're going to have to take some pain. You have to use the daily and weekly charts, and sometimes the 60-minute charts to help time your entries, and sometimes you're going to get in early and you'll have to get stopped out, but you can always re-enter. So again, there's Caterpillar, and take a look at that video, and it'll talk a lot about my style, using these longer term charts. XOM, this is a big one in the S&P 500. And here's a long-term channel going all the way back to 1985. I have two parallel trend lines drawn at the bottom. This one's a bit of an enigma. I typically don't see such a well-defined, clean, ascending channel break down and have prices come back, and usually you would expect a back test. They did come back up and got back within the channel, but have since floundered around and have skirted along the bottom of the channel, which I view as bearish. Yes, prices are rising, but now you're looking at a major top here, this horizontal line, and the fact that XOM is struggling with this channel. And again, like everything else, is prices are going on now and pushing up to challenge to make at least an equal high with their previous highs. These oscillators and indicators are diverging quite a bit, lagging behind. So something to watch on XOM. Boeing, there's a trend line. I don't have much of an opinion on Boeing right now. And finally, Travelers. I haven't marked this chart up. Let's see if I have anything on the weekly. No, nothing on the weekly. That's a strong looking chart. I really can't knock Travelers, or I haven't looked at Boeing on the weekly. Really, it's not been on my radar yet. So that's it, folks. There's a weekly. That's a breakout here recently. New highs. We have the RSI, the MACD are lagging. So not much of an opinion on those last two. Okay, folks, I now crossed the 30-minute mark. Apologize for that for those of you who are still with me, but hope you found the video useful. And just a side note, I will be away from my office all day tomorrow, Wednesday the 13th, and I'll be back in on Thursday. So I'll try to post some comments tomorrow night, Wednesday night. Thank you.